Hello, welcome back to the continuing lecture in lecture series in investment analysis. This is the second video in this topic of bond price and yield. And actually, this is sort of like a review of what we already did in Finance 100. So there's, inevitably some overlap. And if your memory is still fresh from Finance 100, and if you took it in during the summer, the memory would be still fresh. But if you took it in the spring, probably, it would be rusty. But the point is, um, still, it's essential to refresh your memory, and it kind of solidifies your memory and your understanding. Anyway, one thing I want to remind you or bring back to your mind is the inverse relationship. This is a very important aspect of the economics or finance. You would find a lot of inverse relationships, um, and also in Finance 100, I stress this, over and repeatedly, over and over. There's an inverse relationship between the interest rate and the economy, growth rate of the economy. There is in macroeconomics, there is an inverse relationship between the interest rate and the unemployment unemployment rate. Um, in other words, the lower the interest rate, I mean, there is a direct relationship, and if interest rate is low, unemployment rate would be low. But if you're talking about then employment rate, then low interest rate would lead to high employment. And by association, then there would be a inverse relationship between inflation and also, inverse relationship between inflation and the unemployment rate, because when inflation is high, employment would be low. I mean, when inflation is high, eventually there will be a low, high unemployment. But early on, when inflation is high, that means the economy is booming, overheating. So unemployment rate at early on will be low. But a lot of also by association, then when interest rate is low, employment would be high and unemployment will be low. I mean, between employment and interest rate, right? You can see the inverse relationship. This is, quite, quite pervasive across, economics, and also in finance as well. In Finance 100, I also mentioned, I said, stressed, so many times that there's an inverse relationship between the interest rate and bond price. Okay, and why? Why is it? Why is the bond price? That means when interest rates are low, bond price would be high. When interest rates are high, bond price will be low. And why? Well, if you were a good student in Finance 100, you would easily understand why. Because interest rate means there are, when we say interest rate, it can mean many things. First of all, the interest rate the bank pays, right? And that's called the market rate, going rate, prevailing rate in the market. And it's not only the bank interest rate, um, the return that the bond pays. I mean, if you buy the bond, that's lending money, right? So there should be interest, right? There are so you receive two types of return from holding the bond. All right, first, you get the coupon interest. Okay, coupon interest rate is what the borrower or the uh, debt holder, right, pays the what the debtor pays the debt holder or the bond holder, right? What the company pays to the bond holder. So it's a fixed rate, right? So think about it. If you borrow money, right? If you borrow, $50,000, for 10 years, or 5 years, the interest you pay on the loan would have to be fixed, right? Normally, people prefer the rate to be fixed, and they want to lock into a low interest rate, right? It's a common sense. Nobody wants to pay, outrageous rate. And although there are some, floating rates or variable interest rates, but unless you are in a very, disadvantageous position in borrowing, you wouldn't agree to a variable rate, because variable rate means maybe you can, when you borrow, the rate may be low, but 1 year later, the rate may go up to double or triple, because when the rate is not fixed, then the rate that you pay on your borrowing will move together with the market interest rate, right? The prevailing rate in the think about it. The interest rate in the market is changing constantly. Of course, it doesn't change every day. At least there's a pressure for the interest rate to change, but it doesn't change like on a daily basis. The coupon rate can, depending on the market rate at the time you're borrowing, the interest you pay on your borrowing, the loan, may change every day. But that change is not that crazy. It would be hundredth of percentage point, or 1,000th of a percentage point. Now, so the coupon rate is the coupon on the bond is the interest that the company, the borrower, pays the lender. But the market interest rate, prevailing interest rate in the market, is a different thing. So the coupon rate is fixed because when you buy a bond, the coupon rate is already stated, right? They pay fixed rate. But the market interest rate changes, at least like quarterly, or semi-annually or annually. Now the next thing is, so in valuation model, right? You remember in value model, we discount it, and so the discount rate is used. But what is the discount rate? Well, the Discount rate is initially they say, it's what's explained, in generic terms, that it is the prevailing rate in the market. But what's the prevailing rate in the market? Now think about it. I said, a bank interest rate is the prevailing rate. Yes, that's the bank. In case you're, putting your money in the bank. But suppose you are putting your money in the bond. Let's say you have $50,000 and you want to buy bond. More or less, you'll buy about 50, more or less 50 bonds because, the face value is 1,000. But, when you actually buy, the market price would be different, slightly, above or below, or way below. Now, but then think about it. What is the prevailing rate for the bond? Is there a single prevailing rate, one uniform prevailing rate for the bond? No, not at all. Why? First of all, just put yourself. Let's turn the picture back to an individual borrowing money from the bank, right? Suppose you go to the bank and you borrow $50,000. What kind of interest rate will be charged? You will understand the interest rate that the bank charges you, the lender charges the borrower, depends on the borrower's credit rating. You understand? If you have a wonderful, wonderful credit rating, great, excellent credit rating, your borrowing rate, it's also called lending rate from the bank's perspective because they are lending. Your borrowing rate or their lending rate would be very low because you're a low risk to them, right? You have excellent credit score, then you have very low default risk. You are a low risk to them. They don't have to charge high interest because if they charge high interest, someone like you with excellent credit rating can always vote by foot. What does that mean? You can take your business somewhere else. So banking is also a very competitive industry. They cannot charge high interest on a very high quality borrower. But on the other hand, if you're this is Finance 100, material, so I'm not going to go too much on this, but if you're, and vice versa, if your credit rating is, very low, they will charge high interest. So bonds are just the same. Think about it. The borrowers or the bond issuers are whom? Who are the borrowers? Who are the bond issuers? The companies. Well, of course, there are federal government and municipal governments, but generally, companies, right? Corporate bonds, right? Corporations, and corporations also. Firms have credit ratings too, right? And you remember credit ratings, from AAA, AA, single A, triple B. Triple B and above are investment grade. Below triple B are called, junk bonds because they are very high risk, right? But then think about it. Depending on their credit rating, right, riskier companies will have to pay high coupon rate, right? And the excellent, high quality companies like, AAA won't have to pay high coupon interest, right? So then the prevailing rate for high quality companies and low quality companies or medium grade companies, the prevailing market rate cannot be the same for all of them, right? You understand? There is no single uniform rate for all the companies. It depends on their league, right? If you're in the AAA league, the prevailing interest rate would be like the average of what this AAA companies pay. For AA companies, What is the average coupon that AA companies pay? What is the so in other words, prevailing rate for the bonds depends on their league, right? The league of triple A's, league of triple B's, right, and so on. So what that means is your discount rate, right, which is the prevailing rate for your class, right, for your credit class, right, for your risk class, are all different, right? So, but anyway, the bottom line is, it's all mathematical. Um, this discount rate, which is also called yield, right? Once again, yield is rate of return, another name for annualized rate of return, right? Mathematically, think about it. If the yield goes down, what's going to happen to the left-hand side, the bond value? And if you took Finance 100 with me, this must, I've inculcated this in your mind, in your mindset. And it should be quite obvious. There's an inverse relationship. Why? And I've been telling you there's an inverse relationship between the interest rate and bond price. Why? Because if this interest rate, discount rate goes down, think about it, the denominator is going down, right? And the numerator is it's staying the same, it's constant, staying constant. The denominator goes down, what happens to the whole fraction? The whole fraction will go up. Make sense? I mean, that's why there is an inverse relationship, and vice versa. If the interest rate goes up, the bond price goes down. So that explains why there's an that explains that why there is an inverse relationship, right, between the yield, right, between the yield and the price. And this, is called interest rate risk, because when interest rate goes up, right, your price suffers, right? Now, you bought the bond like, 5 years ago, and at the time, prevailing market rate, interest rates were low, and this bond was paying generally good coupon. Now, 5 years later, 5 years after, the rate suddenly goes up by 2% or 3%. Your bond holding will lose value. When you sell it, right, you paid, when you bought it 5 years ago, you pay $700 per bond. And by now, if the interest rate has remained the same, as all the discount bonds rise in value as it approaches maturity, because at maturity it will have to be 1,000. So if the maturity is like 7 years, right? By now it should be closer to 1,000 now, right? So when you paid 700, that was 5 years ago, with only 2 years left to maturity, it should be somewhere around 900, right? But then if the interest rate remained the same, right, remained constant, or even if it went down even, it would be even better. But if it went up, because it gets discounted deeper, right, price will drop, and you don't like that, right? And that's why, it's, a primary source of bond market risk, interest rate fluctuation, right? And then bonds with long maturities are more sensitive to interest rate yield fluctuations, because think about it. Suppose you have 20 years left, right? 20 years left. All those coupon payments will be discounted. For 20 years, you will have 40 coupons, they will all be discounted by a higher discount rate, and your valuation of your bond holdings will go down drastically, right? So bond discount rates, also known as yield or yield to maturity, YTM, prevailing market rate, or comparable similar bonds rate, but they are often worded as bond is priced to yield X%. That means this is the discount rate. Or similar bonds or comparable bonds pay X%. That means this is the average of your risk class, right? So we know this inverse relationship is well captured by this graph. If the coupon rate is 8% and the discount rate is or yield is 8%, then the bond will be par value bond. Bond will sell at par value. Also, this is Finance 100, contents. When remember when coupon rate is greater than the yield, then the bond will sell above face value, right? Or it's called premium bond, and vice versa. Right? If coupon rate is lower than the yield or discount rate, the bond will sell at below face value or par value, so it becomes a discount bond, right? Now, so this graph shows it very clearly. Now, this is market interest rate. In other words, this is Y, right? I'm going to put it here. And this is, bond price. And coupon is fixed, right? Coupon rate is fixed. So, so if they are equal, then 8%, 8%, right? Here's 8%, right? Par value. But if the prevailing market rate is greater than the coupon rate, then see, discount bond, right? Okay. All right, I'm gonna let me. This looks nice. But now, so this is this shows you the inverse relationship between the market rate and the bond price and maturity, right? Skip that. And prices slash yields of U.S. Treasury bonds. You understand? Treasury the maturity to let's take a look at this. August 15th, 2023. It's a Treasury bond, so at least it's got more than 10 years, to maturity, right? the coupon rate is like this, and then uh, uh, yield is like this. That has to be, what can you tell? Huh? Coupon rate is greater than yield, right? And so will this be a premium bond or discount bond? It will be a premium bond. So how do you know it is premium bond? Look at, either, both bid price and ask price, they are greater than $1,000. And you might wonder, oh, that's only $137. Isn't that a discount bond? Listen, look, if you took finance 100, you shouldn't, you can't. If you say something like that, that is outrageous. That's simply, dumb striking. Didn't I tell you all the bonds, bond prices are quoted as percentage of par value. So it's all percentage of $1,000. In other words, par value 1,000, right? So what does that mean? 1,000 is 100 because it's 100%. Now 137 means it's $1,037.43. I mean $1,374. I'm sorry. That means $1,374, right? And 38 cents. That's okay. All bond prices are quoted as percentage of the par value. Okay, makes sense. Clear. All of them are basically because higher coupon rate for the yield, right? But of course, the coupons are not this high now. I mean, they were like, these bonds were obviously issued, around 2000, early 2000, or prior to, at least prior to 2008 financial crisis. Because after financial crisis, interest rate has been very low, right? So coupons cannot be this high. So that brings us to this bond price and bond yield exercise. And in our next video, we're gonna actually do this exercise. This is, and in Finance 100, we did that, basically pricing the bond and calculating the yield and these things. But at the time, we only found, clean price or flat price. This time, we will do, we will make it more realistic, and we will find the dirty price or invoice price. Okay, so that's it for this segment, or that's it for this video. I will see you in the next video, next session. Stop recording.